The biggest long-term winners of the AI boom are actually not the AI companies themselves. They might be the people sending them the power bills and the rent invoices. So in this video, we're going to talk about why AI is really an electricity story and how that points toward energy and infrastructure as potential long-term winners. I'll walk through 4 concrete ways to play this theme. 1 broad utilities ETF, 1 nuclear heavy power giant, 1 AI levered power producer stock, and 1 global data center REIT, renting server space to the entire AI stack. We'll talk about what each one does, how AI demand ties into their business, and which big institutional players own them. Let's start with the big picture. The big picture, AI runs on electricity. Play number 1, XLU, the simple utilities base layer. The first way to play the AI needs power theme is the simplest. Own a diversified basket of utilities. That's where the Utilities Select Sector SPDR ETF comes in. The ticker is XLU. XLU holds large U.S. utilities and independent power producers. As of mid-December 2025, its top holdings include names like NextEra Energy, Constellation Energy, Southern Company, Duke Energy, American Electric Power, Vistra, Exelon, and others. These are the companies that own and operate the power plants and wires that digital infrastructure depends on. In 2025, utilities have quietly had a very solid year. One recent analysis pegged XLU's total return at around the mid-teens, including dividends, helped by easing interest rate expectations and rising demand from data centers and large industrial users. The yield on XLU has generally sat in the ballpark of 2.5 to 3% recently, which isn't huge, but you're combining that income with potential growth as utilities invest heavily in new generation and grid upgrades to meet AI-driven demand. Large asset managers use XLU as the standard utilities sector tool. It's a State Street fund, and it effectively gives you diversified exposure across many of the underlying winners instead of trying to pick a single one. In other words, if you don't want to pick individual utilities but you believe that data center and AI power demand will keep rising, XLU is a clean, simple way to express that view. Now let's move to specific names sitting right in the middle of the AI power story. Play number 2, Constellation Energy, the nuclear backbone. Constellation is the largest operator of nuclear power plants in the United States, with a fleet of 21 reactors. Nuclear offers exactly what AI data centers want: reliable, around-the-clock, carbon-free baseload power. Over the last couple of years, Constellation has turned that nuclear fleet into a strategic asset for AI and cloud giants. In June 2025, Constellation signed a 20-year power purchase agreement with Meta for roughly 1,121 megawatts of nuclear output from its Clinton Clean Energy Center in Illinois, explicitly tied to Meta's data center operations in the region. The company also secured a major deal with Microsoft to restart the 3 Mile Island Unit 1 reactor, now called the Crane Clean Energy Center. The U.S. Department of Energy backed that restart with a $1 billion federal loan, and the plant is expected to return to service around 2027 under a long-term contract to offset Microsoft's data center usage. On top of that, Constellation announced a roughly $26 billion acquisition of Calpine, a large natural gas and geothermal generator with more than 27 gigawatts of capacity. That deal broadens Constellation's portfolio beyond nuclear into flexible gas and geothermal generation, strengthening its position as a full-spectrum supplier to energy-hungry customers like data centers. Analysts have increasingly started treating Constellation less like a traditional regulated utility and more like a strategic infrastructure company for the AI era, as long-term contracts with hyperscalers re-rate how the market values its earnings. Institutional ownership here is high. Roughly 80% of shares are held by institutions. Vanguard is the largest single shareholder with about 12% of the company. Capital Group and BlackRock each hold sizable stakes as well. So, the story you can tell your viewers is simple. Constellation controls the biggest nuclear fleet in the country. It is locking in multi-decade contracts with AI and cloud giants, and some of the largest asset managers in the world already own large chunks of it. That doesn't guarantee future returns, but it shows where serious capital thinks the AI power problem gets solved. Play number 3, Vistra, a higher beta AI power trade. Vistra is a major power producer and retail electricity provider in the U.S. It operates a mix of natural gas, nuclear, and other generation assets, with a strong presence in competitive power markets like Texas and PJM, where data center growth has been especially intense. Over the past few years, Vistra's stock has had a huge move, benefiting from rising power prices, AI-driven demand, and tight regional capacity. One recent analysis highlighted that Vistra's 3-year total shareholder return was on the order of several 100%, reflecting that re-rating. In early December 2025, S&P upgraded Vistra's credit rating to investment grade from BB+ to BBB, specifically citing its strengthened risk profile and the tailwind from data center and AI-related power demand. Recent commentary from analysts and financial media has leaned heavily into the idea of Vistra as an AI power beneficiary, a company whose generation portfolio is well positioned to supply long-term contracts and capture higher capacity prices as data centers compete for megawatts. On the ownership side, institutional investors control the vast majority of shares. Vanguard owns just over 12% of Vistra, and BlackRock owns close to 9%, with other large positions held by FMR, State Street, and major active managers. Vistra also pays a modest dividend and has guided to strong free cash flow generation. But it's important to be honest. This is a more volatile, higher beta way to play the AI power theme. The stock has already run a lot, it can pull back hard, and valuation risk is real after such a big multi-year move. So if Constellation is the more stable, nuclear-heavy compounder, Vistra is the more aggressive trade on AI pushing competitive power markets tighter. Play number 4, Equinix, the data center landlord. The fourth play is not a utility at all, but it still sits right in the middle of the AI build-out. That's Equinix. The ticker is EQIX. Equinix is a global data center real estate investment trust. It owns and operates more than 270 data centers worldwide, with a huge interconnection ecosystem that links cloud providers, enterprises, and networks together. AI is now a big part of that story. In its third quarter 2025 results, Equinix reported about $2.3 billion in quarterly revenue and highlighted record bookings, strong recurring revenue, and significant capacity expansion to meet long-term demand. Management and analysts have repeatedly pointed to AI and high-density compute as key drivers of new leasing. Financially, the company has been growing revenue in the high single-digit range and funds from operations per share a bit faster than that, while increasing its dividend annually. Recent estimates put the forward dividend yield around 2.4 to 2.6%, with double-digit dividend growth over time. Ownership here is almost completely institutional. Roughly 95% of Equinix shares are held by institutions. Vanguard owns about 13 to 14% of the company, BlackRock holds around 11%, and State Street and other big managers round out the top holders. At the same time, we're seeing enormous private market money pile into similar assets. A consortium that includes BlackRock, Microsoft, Nvidia, and global infrastructure partners recently agreed to buy a large private data center platform, Aligned, in a deal valued around $40 billion, with roughly 5 gigawatts of operational and planned capacity. That's a pretty loud signal about what sophisticated capital thinks of the economics of data center infrastructure in an AI world. So Equinix is essentially the public market version of that theme. A landlord for the digital and AI economy, collecting rent and connectivity fees instead of trying to pick the winning AI model. How all of this fits together. The projections from the IEA, Gartner, and others all converge on the same message. Global data center electricity demand is likely to roughly double by 2030, and in the United States, data centers could move from using about 4% of all power to somewhere between 7% and low double digits by the end of the decade. That doesn't just mean more AI. It means more generation, more transmission, more substations, more data centers. Utilities, nuclear operators, competitive power producers, and data center REITs are all directly in that flow of money. So while everyone is staring at a handful of AI names on the front end of the stack, it makes sense to at least consider an AI infrastructure sleeve in a portfolio. A broad utilities ETF like XLU as the base layer, a nuclear-heavy operator like Constellation as a long-term contracted clean power play, a higher beta generator like Vistra, explicitly tied to tighter power markets and AI demand, and a data center landlord like Equinix, positioned to benefit from AI workloads needing physical space, power, and connectivity. None of these are guaranteed winners. Utilities face political risk and rate regulation. Power producers can suffer if prices fall or projects get delayed. Data center REITs are sensitive to interest rates and construction costs. Valuations in some of these names have already moved up on the AI narrative. So you still need to think about position sizing, diversification, and time horizon. But the bigger point is this: if AI really is the next industrial revolution, it will not just reward the companies building the models. It will also reward the companies that sell them electricity, capacity, and space. You don't have to choose between AI and energy, you can own both. Just don't forget that behind every flashy AI demo is a very large power bill, and someone is getting paid to send it. Right now, AI isn't just software. Underneath all the hype, it's a massive industrial load on the power grid. According to the International Energy Agency, data centers globally used around 415 terawatt hours of electricity in 2024, about 1.5% of all electricity used worldwide. That number is projected to more than double to roughly 945 terawatt hours by 2030, driven largely by AI and accelerated computing. Gartner's forecast is similar. They see data center electricity demand rising from about 448 terawatt hours in 2025 to around 980 terawatt hours in 2030. In the United States alone, data centers consumed about 183 terawatt hours in 2024, more than 4% of all U.S. electricity use. Several studies now project that by around 2030, U.S. data centers could be using between 6.7% and 12% of all U.S. electricity, depending on how fast AI builds out. A recent report for U.S. policymakers found that data center power demand could roughly triple by the end of the decade, which would require tens of gigawatts of new generation and major grid upgrades just to keep up. So here's the key idea. If AI demand actually plays out anywhere near these forecasts, the bottleneck won't just be chips and GPUs, it will be electricity and infrastructure. And that's where utilities, power producers, and data center landlords come in.